The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. And with me today, as always, is the senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are you going?
Very good, James. Glad to be with you again.
Fantastic. Well, today we're going to ask how much more pain the RBA has to inflict. We're going to examine the gold takeover that's got everyone talking and look ahead to another big test for the economy, earnings season. But first, Tony, you and I have been both following the rise of GPT very closely this year, and this week we saw artificial intelligence, I reckon, move from what I'd call a cool curiosity to something of a moneymaker. And Microsoft and Google announced the launch of search engines that are AI-enabled. Tony, now you've had a bit of a play with the AI version of Microsoft's Bing search engine. Can you tell us a little bit about how AI makes searching for stuff even better?
Well, it's in some ways, James, like talking to a person because you are chatting and asking. And one feature that I looked at was can you give me an itinerary for a trip to Europe? And then it recommended 5 places to go to. And then the next question down was, could I book a flight to Malaga in Spain? So, and I've watched also a video of a Wall Street Journal reporter who went to Seattle for the launch. And that was quite interesting, the sort of questions she asked. One of the best was, how would Satya Nadella, the CEO of Microsoft, answer a particular question? She didn't tell him, and then later did an interview with him. And guess what? The way he answered that question was very similar to what GPT said.
Wow.
So, I mean, this is slightly spooky.
What a great experiment.
But I think you're right. This is the greatest sort of arms race in technology we've seen for a very long time. I mean, do you have some confidence that Google will come back at them hard?
Well, Google has had a crack with its own launch in Paris overnight of its AI-enabled search engine, which is going to be called Bard, which is sort of an interesting name, but it seems to have gone a little awry. In the demonstration, they asked Bard a question about the Hubble telescope, and it got the answer a little bit wrong. And Google shares have been sold off. In fact, the parent company Alphabet lost $100 billion US in value on Wednesday night, which was the steepest one-day decline since October last year. I think this shows the danger here, Tony. It's exciting technology, but it is developing technology, and there's a risk for Google and Microsoft that as you sort of launch these things well before they're fully formed, there's a risk that the tech isn't good enough. That what we have seen with ChatGPT, that it does mix up fact and fiction to some extent, and this is there's a reputational risk here, and that was manifested in Google's share price on Wednesday night.
Yeah, definitely. I think this is actually quite personal too, because we know Satya Nadella launched Bing in 2009, and he made a very pointed comment this week in a blog saying that there's 10 billion searches every day, but half of them go unanswered.
Right.
So now we know that that's 93% of all searches are done on Google. So he was really making a pretty big shot there at Google. But I think Google might have panicked. I think Microsoft is well ahead of them. They've had to rush out their product without the full development, and it's obviously backfiring. But, it's massive. We're talking $250 billion of search revenue that could go the way of Microsoft, or part of it anyway.
Well, I mean, the one thing I have sort of seen is that Google's got such a big lead in consumer search and consumer products that maybe that's going to be hard for Microsoft to crack. But Microsoft could really make some inroads against companies like Salesforce with products for business that are AI powered. They released one last week that helps salespeople write emails to prospective customers. It grabs, their contact details and some pricing details and a promotional offer and whacks this email together. Now, that's pretty clever. Obviously, you'd want to go through it with a fine-tooth comb, but it just shows the the potential power and productivity gains you could get out of this stuff, with that caveat that it's very early stage.
And one thing I'd say about Google, they've got an ace up their sleeve, and that's the Android platform. Now, remember, Microsoft's really failed to make it in mobiles, but if Google can put their generative AI into laptops and mobiles, that could be quite a powerful counterpoint to Microsoft.
Yeah, maybe we'll have to ask ChatGPT to set out the script for a Chanticleer podcast at some stage, Tony, and see if it does a better job than us.
Oh, jeez. I hope they don't replace us before I leave at the end of March.
No, you'll be fine, but I should probably be worried about the years after that. Now, Tony, I mentioned earnings season. We're going to have a look at what's coming next week. It's a huge week next week, but we started to see the first profit results this week. Suncorp, Boral, Amcor, AGL. Have you got any early reflections on where we're at so far?
Well, I think the best comment I could make is one based on your column, that basically they're all pushing up prices. Inflation is really biting them in terms of the cost base, and they're all trying to move as fast as they can to maintain their profit margins. And fortunately, we're not seeing the pattern of American technology companies of just slashing bodies. They're trying to be far more intelligent about it. And in fact, Vic Bansal from Boral said to me, I'm not going to be doing what my predecessors did in announcing big cost-cutting programs every 6 months, because it just damages morale.
Yeah.
He doesn't want his people constantly on the cloud of getting the chop. So that was one theme that came through to me. What did you think?
Yeah, look, I think that's right. The other thing was just the level of uncertainty. I spoke to Amcor CEO Ron Delia, and his point was that everything sort of hinges on where demand goes. Now, yes, that's always the case, but he was sort of saying we've got more different scenarios that we're planning for than we ever have before. We just don't really know where this is going to land. Makes it very hard to make decisions like, how much capital do we allocate to certain parts of the business? What do we do about cost cutting? How do we adjust our supply chain? So I think CEOs are, they're not quite flying blind as they might have been in the early stages of the pandemic, but they are going to have to be pretty agile to respond to some of the trends we're going to see in the next little while.
Yeah, good point.
AGL was on Thursday morning. We've covered AGL a lot on the podcast. More of the same. Any light at the end of the tunnel for AGL at this stage?
Oh, look, James, I think the key thing I got out of talking to, Damien Nix, the new CEO there, was that he's got the second leg of his strategy coming up at another investor day. Mm-hmm. And it's all about the decarbonisation of the 4.2 million consumers who are customers of AGL. Now, I think what this is all about is getting more solar panels, more batteries, helping people to finance those through sort of leasing and other arrangements, which, could be quite significant when you consider Australia, I think, has the largest number of solar panel rooftop installations per head of population in the world.
Yeah, okay, well, that's one to watch. Well, Tony, let's jump into our first topic. And the reason that there's so much uncertainty out there for CEOs is that no one's quite sure what's going to happen with interest rates. And this week we saw the RBA raise rates by 0.25% to 3.35%. And more importantly, Governor Philip Lowe was very hawkish, by which we mean that he appeared to be suggesting that he would raise rates further in order to take down inflation, and suggested that there are more rate rises on the way, with some pretty strident language. And now economists are thinking we either rates get to 3.8%, so that'd be 2 more hikes, or even to 4.1%, which would involve 3 more hikes. Tony, were you surprised at this? Certainly the market was a little bit surprised on Tuesday afternoon that the governor was quite as hawkish as he was, because stocks are pretty much priced for a soft, gentle landing, and what they're getting here from Philip Lowe is, hang on, fellas, we might need to be higher for longer.
Yes, I think what shocked everyone was the fact that he was willing to abandon previous language about we have no preset sort of interest rate rise agenda, and suddenly said, okay, there's at least there's rate increases, 2 of them at least coming, and that is understandable given that their forecast for inflation this year is 4.75%.
Yes.
And they want to get it down to the band of 2 to 3%. So there's obviously work to be done on that front. But coming out with such strong and different language, I think we saw the stock market drop like a stone, although it has bounced back a bit on the back of the banks, which do well out of rising rates. But yes, I think, we're sort of seeing a different Philip Lowe this year, and we're not really getting that sort of conversation with him that would normally happen. I think he would normally this week go to the press club and give a speech, but he's put that off till the 17th of February, a parliamentary sort of committee. Do you think this is unusual, his change in communication strategy?
I think it is a bit unusual. I'm not sure why he would have skipped that sort of agenda, year ahead speech at the press club. I think we would have liked to hear from him, and markets would have benefited from that probably, or market observers. But and I think what it's also left this sort of gap in the conversation that has been filled. I mean, I don't know if you saw the Green Senator Nick McKim came out and called for Lowe to be instantly sacked by Jim Chalmers, and for Jim Chalmers to reverse the rate rise that we saw on Tuesday. Now, I mean, that would just destroy the independence of the RBA. It's hard to know if McKim was serious about that, but there's a level of feeling out there about Lowe that doesn't seem to go away, does it?
No, and really he's trying to do his job with all the information he's got at hand, but he's also got to consider what's going on around the world. I mean, you think about the Aussie dollar, say, collapsing if we get too far out of step with America, and then suddenly we're importing inflation through the currency. So there's this sort of delicate balancing act between what's right for Australia and how he has to respond to other central banks.
Yeah, absolutely. I thought it was very interesting, Tony. We saw a bit of a different tone come out of the banking sector. The banks have been pretty good at saying, we manage these risks really well. Our housing loan books are in good shape. And then we had ANZ Chief Executive Shane Elliott this week saying, well, we're hitting the buffers that the people who took out a loan in the middle of the pandemic when, rates were close to zero, we're hitting the buffers that we set for those people now, and it's going to get harder from here. What did you make of that in terms of what we see going forward?
Gee, I thought it was a bit strange because the bankers I talk to tell me that ANZ's going hell for leather on home loans at the moment. But if he's referring back to the middle of COVID, that's when the ANZ loan processing system just wasn't working at all. I mean, is he trying to say that we never wrote any bad loans in the middle of COVID? Or,
happy
I'm not
accident,
sure,
yeah.
But it's an unusual sort of commentary. But
do you see much pain for the housing sector coming?
Well, we know from evidence given by the RBA to that Senate committee looking into the cost of living, which is chaired by Senator Jane Hume, that an RBA official said that there are 800,000 households will this year switch from fixed rate to variable rate. Now, that's a huge, perhaps for some, 300 basis points of additional interest charges on their loan. I think the more the RBA raises rates, the more likelihood we're going to get a spike in defaults at the big banks. Yeah.
Well, do you think the RBA starts to worry about some of that? They've shown no real concern about the housing market or the stock market or sort of any fragility around high household debt. Does that start to come into their calculations as we really get towards the peak of this tightening cycle?
It probably does, James, because, well, we know that the biggest cause of defaults is unemployment. And if unemployment starts to rise, and of course one of their objectives in their mandate is to, maintain full employment. So, it must start to weigh on them, and that's why all the big economists, the leading economists are saying we're going to have rate cuts, perhaps by the end of the year or early into 2024.
Yes. We're getting to the bit where it's really going to get hard for Lowe. So everything's been finely balanced for a year. It's really finely balanced as we get towards the peak of this rate hike cycle. So Tony, after what you heard on Tuesday, what do you reckon? Is it two more rate rises, or is it 3, or is there room for more than that?
Well, I've always been arguing for a soft landing, so I think 2 should be enough, and hopefully that'll get us there. Yeah, who knows?
Yeah. I think I'm with you. I think it's probably 2 and pause, but I don't know. I feel the confidence of our economists in Australia has been a little shaken this week. They're caught in a tough place where, do they listen to the RBA, who's got their forecasts mainly wrong over the last couple of years, or do they sort of go with their own view of the how the economy should how much tightening the economy can take? So I don't know. It's a tough one. I think you're right though. 2's probably what we'll get, and we'll see from there. Well, Tony, the second big news event of this week came on Monday when we saw a true mega deal hit the ASX. That was when the US gold miner Newmont, which is the world's largest gold miner, offered to buy Newcrest, which is Australia's largest gold miner, for $24 billion in its own shares. So there's no cash going to change hands here. It's all Newcrest shareholders would receive Newmont shares. Now, there's some fascinating history here because Newcrest effectively grew out of Newmont's Australian subsidiary, which was set up in the 1960s. But Tony, this deal's part of a wave of consolidation that's been rolling through the gold sector for decades, isn't it?
Yeah, this sector seems to attract M&A activity regularly because the economies of scale that can be gained from putting 2 mines together. And I think that's what the reasoning was given for this particular deal, that Newmont gets scale, geographical and operational diversity, mineral reserves, and a global company can take advantage of selling gold much more efficiently. Yeah.
I mean, I think that's right. There's 2 important factors here for that I can see, and that's Newcrest has good assets that are producing gold now. Gold mines are getting harder to set up because government approvals and that sort of thing are just generally tougher to get in the mining sector. But also the gold that's in the ground is getting harder to get out of the ground because it's deeper underground. It's in more difficult to mine places. So what Newmont's trying to do here is increase its gold production, and Newcrest can help it do that. Plus, Newcrest's got this suite of nice growth assets in Australia, but also in British Columbia, where it's set up a big business in Canada. It's a funny asset class, though, isn't it, gold, Tony? Quite divisive. Some people love it. Some people don't quite get it. And of course, gold's in this weird place where it's got some utility, particularly for jewellery and in some small industrial uses, but largely it's an asset class of its own. It's almost a tool for not speculation, but a store of value historically. Yeah,
it has that. It's got that sense of mystery and sort of, I suppose, you own it. It's glistening. You can hold it if you want to. I mean, I bought some gold through the Perth Mint, and one day I might actually get over there on a holiday when I've finished up at the Fin Review and go and pick up my physical assets and carry it away. But I'm not sort of person who wants to hug gold at bed at night. But I think the reason that people like gold miners is because they actually pay a dividend. Because your traditional gold investor is just holding this lump of precious metal that is really a punt on capital gain, whereas you buy Newcrest or Newmont and you'll get a dividend yield, which is basically taking advantage of the cost of digging it out of the ground and the cost of selling it. And of course, gold is, I think, at the moment about a 9-month high.
Yeah, that's right.
So
that's right.
It's sort of in a good place, or better place it's been for a long time.
Well, we look forward to your selfie from the Perth Mint with your bars of bullion. What do you reckon this deal? It's a huge transaction if it goes ahead. What does it mean for the broader M&A picture? Is this a sign mergers and acquisitions might, they've started the year off on an okay footing and they might come back a little bit?
Yeah, look, I think that obviously Newmont, a global company, can see value. It's not actually paying cash, as you know. I think you said earlier, it's actually a share trade in this situation. So you're getting shares in this big global company. And of course, I saw a good analysis which showed that if you look at the amount of resources that Newcrest has at the current gold price, it's actually probably worth about $40 compared to what its peers are valued at. Now, that's a lot more than what Newmont is offering. So I don't know, there's probably going to have to be more put on the table to get control of this company. And by that, I mean offering more shares in Newmont.
Yeah. Well, that's a great point. I think the current bid is around $27.5. So that's the value implied by the merger ratio. Tony, you've just mentioned some analysis puts it at 40. So do you think there's perhaps another bid that the Newcrest board might force out of the Newmont board?
Yeah, probably somewhere between 27 and 40. So low 30s will probably get it, James, I reckon. But let's see. I mean, one disappointing aspect of all this is that he was one of the fewest ASX-listed top 100 companies with a female chief executive in Sherry Dew. She'll probably lose a job.
Yeah.
With a massive payout, of course.
Yeah, quite possibly. All right, well, we might learn a little bit more next week because Newcrest has their earnings in the middle of the week. And after the break, we're going to come back and look at some of the big hits from earnings season that are coming up next week. Okay, Tony, we're entering one of the busiest periods in the Chook yard, and that is the semi-annual reporting season. We have one in February where companies deliver their half-year results, and we have one in August when we get the full-year results. And things really hot up next week. I think we've got on Tuesday CSL, on Wednesday we've got Commonwealth Bank, Wesfarmers and Seven Group. On Thursday we've got Telstra. This is a big week, Tony, and we should get a good readout as to what's happening across the broader economy.
Yeah, we should. It's always sort of peak of reporting season. Interesting, CommBank. I noticed the News Limited tabloids have started to attack it for raising loan rates faster than they cut rates when rates come down. So maybe we're going back into that cycle of the banks are evil.
Yes.
Again, you remember that? It comes around every so often. So their profits could generate a bit of a backlash from some sources. Interesting on CSL, I noticed they're not going to have a media briefing next week, James. That's a little bit unusual. So I don't know if the outgoing CEO, Paul Perreault, or the incoming guy, Paul McKenzie, have suddenly gone a bit shy, but they're going to match it all up in one large analyst briefing.
Okay, well, I'm sure Paul Perreault will make some time for the Fin Review somewhere, so we'll quiz him. CSL shares back up near record levels, Tony. It's an impressive company, isn't it?
Oh, it's just amazing. And I may have told you before, my dad participated in the original IPO and did very well out of that.
Yeah, fantastic. A couple of other things to note next week. US inflation on Tuesday night. The Federal Reserve will be hoping to see a bit more downward pressure on inflation. I noticed Joe Biden in his State of the Union address was spruiking the fact that inflation has fallen for 5 consecutive months or something. You know, it's still 3 times the the target level of the Fed Reserve, but you got to take some wins where you can find them, eh?
Yeah, that's right. I mean, potentially this will help us confirm what some believe is the Goldilocks scenario, where inflation in America actually moderates faster than expected, the Fed pauses quicker than expected, and all those concerns about the recession just dissipate. I mean, that sounds like a big call.
That sounds lovely,
do you think it'll happen?
It? Oh, I don't know if that'll happen, but I think we'll see another step down in inflation on Tuesday night. And look, that's the direction we need to be going in. The question I think now is how quickly inflation unwinds and how quickly it can get back to those target areas. Along similar lines, Tony, we talked a little bit about the RBA rates and what they might do to the employment market. We get the unemployment number next Thursday. It's tough, isn't it? No one likes to barrack for job cuts or job losses, but the RBA does want to see unemployment tick up a little bit, doesn't it?
It does, yes. But to be honest, this economy's in many ways doing incredibly well with unemployment at the lowest level in 50 years, isn't it?
Yeah. Interesting. Last week I was on the Atlassian call, the Australian-born tech company, and Scott Farquhar, one of the co-CEOs from Atlassian, he made a good point. Someone asked him about these tech layoffs and would that hurt, Atlassian because their sales to the tech industry would be lower, and he said, all the tech guys are being rehired straight away. They're all walking into new jobs because there's a deficit of tech people around the world. So, he was sort of playing down the impact of those tech layoffs. So I wonder if, there will be a bit of churn in employment markets for a while. Tony, let's give our readers something to focus on next week. Which company result are you going to be most interested in next week?
Look, I know this is one of my obsessions, James, but the ASX is reporting next Thursday. They've obviously had that terrible debacle over clearing and settlement. My suspicion is that their costs are going to go through the roof because of that. On the whole CHESS thing, I got a very interesting email from a reader who was very worked up and saying, have you seen this? Because of overload, CHESS is actually physically going out and buying servers to solve a problem. And then I clicked on the link and discovered that he got it completely wrong. It was the chess gaming app, which is taken off. I mean, this is crazy stuff, but maybe the Queen's Gambit, that Netflix series, other stuff happening, maybe COVID, but people are playing more chess than ever. And it's causing their systems to crash. So it wasn't the ASX at all on that one, but I think there's legitimate concerns about how the ASX will compensate people who invested hundreds of millions in a system that's not going ahead. Yeah,
absolutely. My big one is Wesfarmers. Two things to watch. How is retail conditions holding up? Obviously, they own Bunnings and also Kmart and Target, so we'll get a good view there. The other is they've got a big lithium project. Lithium stocks have been running hot, and they've got a mine called Mount Holland, which they're bringing towards production. So it'd be great to get an update and see how they're going there. The lithium price has plateaued a bit this year, but still looks pretty hot. All right, now we've got a great question from a reader. We love your questions. Send them in to chanticleer@afr.com. This question comes from Dean in Perth. Dean Bennett in Perth, and he says, "Hey guys, really enjoyed the podcast and will miss Tony, but wish you all the best for your retirement. On January 19, 2023, the United States hit its debt ceiling of $31.4 trillion, and Californian state debt has reached $777 billion. At what point does the US debt start to affect the economy and also the global economy, or is it too big to fail?" Great question, Dean.
Yeah, look, if I can go first on this one, I don't know if you remember, I wrote the 5 big catastrophic potential events you needed to think about. One of them is America defaulting on its treasury bonds.
Yeah.
And this goes to the issue that he's raised. The debt ceiling in America is sort of become a political game, and between the Republicans and the Democrats. The corrosive politics in America makes me quite concerned about this whole thing. And in fact, when I had lunch recently with Andrew McCaffrey, the global chief investment officer of Fidelity International, he said to me, we really got to keep a close eye on this. He said it won't necessarily be seen in the bond market. They won't necessarily worry about default, but people will start to worry about the impacts on the economy, and that's where it will really be felt in the stock market. So, we already know the S&P 500 is trading at about a forward PE of 18.5. It's pretty high and stretched.
Yeah.
Just any concerns about a debt default, and that could really puncture the bubble.
Yeah. And having watched the State of the Union yesterday, and you had people screaming from the back seats calling Joe Biden a liar, and it was pretty fiery at times. You can't see a peaceful, easy resolution to this, can you, Tony?
No way. I mean, the Republicans are fighting among themselves more than they're fighting with the Democrats. So that can't help for a sensible resolution.
Yeah, absolutely. Fantastic, Tony. Just to finish with a recommendation from me, I know Our audience loves consuming great content. I loved a podcast this week. There's a podcast that Bloomberg puts out called Odd Lots. It's reliably good. A couple of podcasts a week, they're reliably good. This week they had a guy called Steve Eisman, who was a star of the book The Big Short, one of the guys who got the bet against the mortgage market right. And he had some great reflections on what's coming up and in the world. He doesn't see a terrible recession coming. He thinks the banks are extremely well capitalised and pretty strong. But there's some great stuff in there about how paradigms shifts in markets that I'd really recommend people listen to frame their thinking about what might be coming. It's fascinating stuff. Anything you've liked in the last little while, Tony?
Well, I've been watching Madoff, the Monster of Wall Street on Netflix,
Yes.
and I'm really enjoying that. And in particular, there's a standout person in that miniseries. Now, her name is Diana Hendricks, and she wrote a book called The Wizard of Lies, Bernie Madoff and the Death of Trust. And she's incredible. Her clear-eyed analysis of the world's largest Ponzi scheme, I think, is or maybe it's the second largest, but it's just incredible.
Second largest now. We've got FTX, of course.
Exactly,
Tony.
that's right. So, but yes, it's a dramatised version with interviews with real players involved from the FBI and various other agencies, and absolute complete failing by the Securities and Exchange Commission in America they were given a number of different warnings over a period of 10 years and did nothing. So it's quite sad that, an institution so well respected around the world just couldn't do their job.
Yeah, it's a great lesson, that documentary, in people seeing something that's too good to be true and often believing it. It's well worth the watch. Great recommendation, Tony. Well, thank you thanks for joining us on the Chanticleer podcast this week, and good luck for another big week of earnings season next week, Tony.
Yes, you too, James.
Well, if you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us, and follow us wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd. The producers are Lap Fan and Alex Gow. Our theme music is by Alex Gow. See you next week.
The Australian Financial Review.